So hopefully you've watched the Chapter 9 lectures by this point, and I think you'll find that this chapter can be relatively simple because most of us do understand what a budget is and the purpose of making those. I want to walk you through some of the more difficult budgets that you're going to have to deal with in this chapter, and they always go in order. So you remember, you always have to start with your sales budget, because if you don't know how much you're going to sell, you don't need to know how much you have to make or how much materials you have to buy. So remember, we're always going to start with that sales budget. From these sales budgets, every budget builds off of each other. So we're going to start with that sales budget so we know how much we need to produce. So I'm going to come down here to this production budget, and we're going to start here. From this production budget and every budget, we're looking at a simple formula. How many do we expect? We're going to add in that ending inventory to tell us what's available. We're going to subtract the beginning inventory to tell us how much units we need. We're going to keep doing that for each of our budgets. And remember, you do want to have something in your ending inventory because a budget is just a guess. So we want to make sure we have a little extra just in case we sell more than we expect. So let's start with this production budget. First, we're going to start off by inputting how much we expect to sell each month based on our sales budget. In October, we expect to sell 10,000. In November, we expect to sell 12,000. And in December, we expect to sell 15,000 units. I already have this pre-populated in Excel so that I don't have to do the math. So you'll see these numbers change as I keep inputting numbers. So we started with our expected units sold. We're going to add in our ending inventory. They're going to give you that desired ending inventory. So in October, my desired ending inventory is going to be 15,000. November, again, they give it to us, 13,000. And in December, it is at 1,100. We're going to subtract our beginning inventory. One thing to remember and keep in mind that our beginning inventory is always the previous month's ending inventory. So September 30th is going to be the same thing as October 1st. So my beginning inventory is the last month's ending inventory, right? So in November, I'm looking at October 31st to find that beginning inventory. So I'm going to look to my October ending inventory to get my November beginning inventory. Same thing in December. I'm looking to my November ending inventory to get my December beginning inventory. And remember, this is just a simple formula. How many do I expect to sell? What are my ending inventory requirements? How much is that total? Then I'm going to subtract out how much I already have to get how much I have to produce. Once I know how much I have to produce, I can bring those numbers down to see how much I need to buy and look at my direct materials budget. So in your direct materials budget, remember you're looking at how much material you need, not necessarily how much units you have to produce. That's where we're going to start. So again, I've already pre-populated this. In October, it's coming from my production budget, October number, November, coming from my production budget, and December also coming from my production budget. The materials per unit, they have to tell you this. We're making phones here and they require 3 data chips to be inserted. So each unit I make is going to require 3 direct materials. So my direct materials budget is going to be based on the materials needed, not necessarily units I need to produce. I'm going to add in that desired ending inventory like I had done in the previous problem. So they're going to give this to us for this problem. The first one is 4,500. Second one here in November. Again, they give this to us. We're going to bring that down. Third one, they're going to give to us. Looks like I didn't need to copy those formulas over. So now I'm going to subtract out that beginning inventory. Again, your beginning inventory is last month's ending inventory. September 30th is going to be the same thing as October 1st. So I'm going to bring in those numbers. For November, I'm looking at October 30th. And for December 1st, I'm looking at November 31st. Now you'll notice that all of these numbers are based on the materials required. We're talking about our materials that we needed, not the number of units we need to produce. Because now we know how much material we need to purchase. All we have to do is go in and say, each of these materials cost us $5. This is coming from the example. We're going to multiply that out to see how much this is going to cost us each month. Now that we know how much we have to buy, we can move down to say, well, what is our cash payments going to look like? Again, each budget will build off of each other, which is why we have to start with that sales budget and move forward. So since we know how much we need to purchase, we can look at our cash payment schedule. This first month, October, we have $135,000 that we need to purchase. So I'm going to put that in. I'm going to put in our November purchases, and I'm going to put in our December purchases. You'll notice I have that September up here because it's telling me I have an accounts payable at September 30th of $3,500. That accounts payable from September is going to come in during October. I'm going to pay that off in October. So we have to keep that in mind. They also tell us that we pay 70% of the purchases in the month of the purchase and 30% the following month. So I have my October purchases. I'm going to pay 70% during October. The other 30% are going to be paid that following month. So I'm going to take my purchases from October, and 30% of those are going to get paid in November. In November, I'm going to do the same thing. Obviously, I can't pay for something in October that I bought in November. That would be silly. So I'm going to start in November. I take my purchases from November, and I say 70% of those are paid during that month, and 30% of those are going to be paid that following month. In December, I'll do the same thing. In December, I'm going to pay 70% of those purchases. Now, 30% are then going to be your accounts payable. So if I did want to figure out how much my accounts payable would be, I would take that total from December and realize that this amount here would be my accounts payable going into the new year. They also probably will want you to figure out, well, how much am I going to have to pay for that entire month? To do that, I look at all the payments I'm making during that month and just add them together. So in November, I have 2 payments I'm making related to 2 different purchases. In December, same thing. And that's going to give you your total payments for each of those months, so you can go on and build a cash schedule. So you know what's coming in and what's coming out, and to know whether or not you need to borrow some money. So hopefully that helps. I'm going to give you some more examples to look at from homework, and hopefully between those, this chapter will make a little bit more sense. If not, send me an email and we can figure out how to help.